Thank you very much. So it's nice to be here again. I have a personal relationship to this business school, of course, because I made my Kellogg WHU MBA here 9 years ago. And it's a pleasure for me, of course, to host this panel. And I will give a short, brief note on my personal CV. So I just held managerial positions in strategy consulting business and heading in the field of communication. And so I have my own strategic communication consulting business now together with 5 partners. And before that, I studied economics and politics at University of Cologne, and then I worked as a reporter-in-chief at Financial Times in London and also in Germany before starting my consulting career and absolving my executive MBA here at WHU. We have 4 excellent experts here in the fields of finance, and we will discuss a very interesting topic here today, which is very often in the media and in the public debate. It's the question of low interest policy. We have the phenomenon of low interest policy for a longer period, and the question will be, what are the consequences of low interest policy for banks, but also for companies, individuals, and society as a whole. We will start with a personal introduction. To my left is Marisa, and she will start with her introduction.
Great. Well, good morning, everyone. I'm delighted to be here, and it's wonderful to see such an esteemed audience. You can tell by my accent that you'll find that I'm the only non-German on the panel from an accent point of view, but hopefully I will redeem myself because when I was very young, I lived in Wiesbaden, Germany for a little while. I call myself a citizen of the world. Someone had asked me where I'm from, and I said everywhere and nowhere because I've moved every 2 years pretty much throughout my life. I currently am in London, and I have been there longer than I've been anywhere for a good 12 years now. And I have 2 hats at Credit Suisse. One is that I look after investment banking for the EMEA region, Europe, Middle East, and Africa, classic investment banking business, the advisory business and financing businesses. And the second hat I wear is a global hat looking after all of our financing businesses. So that group is called Global Market Solutions, and that encompasses debt capital markets, equity capital markets, leveraged finance, and derivatives. So a very big, complex world that I look after, and very much in the frame of what we're going to talk about today, so I'm looking forward to entering the debate.
Yeah, my name is Konrad Meyer. I'm working for Waterland Private Equity now in my 7th year. I'm 32 years old, studied in Cologne, live in Cologne, so not as much a nomad as you are, but still I get around. Very happy to be here and looking forward for that discussion.
Okay, my name is Mark Wahrenburg. I am professor of banking and finance at Frankfurt University. Before I started my academic career, I actually was a consultant with McKinsey, and we tried to convince the banks that risk management, and especially interest risk management, should be something interesting for them. At that point of time, nobody was interested in this topic, especially given that interest risk is a complex matter, where things like variances and covariances, duration and convexity, all are part of today's risk management models. At Frankfurt University, I do a lot of research on banking, obviously. I'm also the founding dean of Goethe Business School, and we deliver lots of executive education programs. A large part of them actually for regulators that often come to Frankfurt in order to be consulted and helped on shaping future regulation. And of course, low interest rate environment is the result of a regulatory response to the financial crisis.
Hello, my name is Meckel. I studied at WHU and did my diploma here in 2002, and I was a member of the first organizing committee of the first Campus for Finance conference in 2001. So for me it's extremely gratifying to see how the conference has grown, and thanks everyone for joining us year after year here. Please continue coming. Right now I also live in London. I work for Goldman Sachs in their financing business since 12 years, but the topic we're discussing, cheap money, I'll express mostly my own views, not the one of my employer necessarily.
I like that disclaimer.
Okay, very good. Thank you very much. Welcome back, Jans, also. So to sum it up a little bit, we have here the investment banking world represented by Marisa. We have the private equity world represented by Konrad. We have the more traditional banking world represented by Mark, and of course the view of Jans from the capital markets point of view. So these are the experts for this quite interesting and complicated field of the question of low interest policy. The questions, as you have read it in your personal brochure, is that central banks have mitigated the interest rates to a historic all-time low. And we have a situation now here that borrowing money is less cost-intensive, but also it's very less cost-intensive, and we have real negative interest rates to occur. And this is, of course, having an interesting impact and a strong impact on the business model of banks, but also of the financial condition of states, and even individuals have to adapt to this situation. So we would start in this panel, again with Marisa, from evaluation how she or the other participants see the situation, and then would come to a more open discussion with regard to the consequences. The structure of this panel is that we have a 30 minutes discussion, and after that, for the last 20 minutes, you have time to ask your questions to these experts. Marisa.
Okay, well, maybe I can touch on two topics as it relates to what I see as a byproduct of this interest rate environment. And it's almost two sides of the coin, if you will. And the first is from the investor standpoint. I've grown up actually financing high growth or early stage companies in the leveraged finance world, and also private equity firms. And what the phenomenon that we have seen is that in the investor community, as they are not getting a decent return out of traditional debt investments, what we're seeing is the investor community is taking more and more risk going further down the credit spectrum to try to achieve a yield in their portfolios so that they can produce the returns for their investors. So what that's done is driven a massive increase in the leveraged finance market in Europe. I actually moved to Europe to help start up European leveraged finance for my former firm when this was a nascent idea to have a standalone European asset class in LevFin. And at that time, it was about a $50 million market in our first year. And this year, we will hit 100 billion of new issue volumes in European leveraged finance. And that's about a 60% increase on last year, which was about a 50% increase on the year before. So what you're seeing is a massive appetite on the part of the institutional investor community to grab yield, to go down further into the credit spectrum in order to get that return. Then the other side of the coin is the people who are issuing, who are actually raising capital, and that is the corporate world that I look after. And if you are the chief executive or the FD for any corporate company, and you take a look at the interest rate environment, and you say that I can raise money at all-time low rates, why wouldn't you do that? So what we are advising our clients is, we think it is inevitable that rates will eventually rise, and if the capital markets is willing to provide you 10-year money at virtually no cost, and in many cases very, very light covenants, why wouldn't you take that money, put it on the shelf, and forget about it? So what we've seen as a phenomenon is the corporate client universe has massive liquidity stores because they've gone and accessed the capital markets, raised that cheap capital, and put it on their balance sheet. And we'll come on to what they're doing with that, because at the moment, it's high cash on balance sheets and not a lot of investment, and that's another part of this discussion, but those are two of the phenomenons that I'm seeing as a byproduct of the interest rate environment.
Yeah, maybe I just continue on your first point. Of course, you're talking about liquidity in the market. What we see is that there is a lot of liquidity available also for private equity. We see that with very fast and very high fund closures. What we also see is a significant availability of leverage finance for our deals that is driving private equity activity, I think, worldwide and also in Germany considerably. It's also driving asset prices. I must say that relative multiples are going up. So we all are actually buying at higher prices. In the end, and we are talking we are talking here is about the macro politics. I will also emphasize a little bit on the individual. When we go to an entrepreneur who is who's heading a company, owning a company, and we try to convince him to sell that company to us, we have a very tough time these days, because people don't know what they shall do with the money. They don't know where to invest it. We debated it a little bit earlier, but and we will touch on that I think later, but it's more the perception that you don't get anything for your money in the open than it is probably really the case. But everyone is saying gold is overrated, equities are overrated, housing prices are overrated. So they don't know what to do with the money, and that is a counter driver against deal activity in our markets at this point in time.
Yeah, okay, so let's switch the viewpoint to the traditional banks. Traditional banks were rescued in 2007 by government and central bank intervention, and the first intervention was to lower the interest rates, because banks need to refinance a lot in the market, and the lower the interest rate the banks have to pay, the better the banks are off. So in the first place, lower interest rates meant relief to banks, access to cheap funding that they urgently needed. Now, after 5 years of declining interest rates, banks are again crying. And you may say banks are always crying, because they never make enough profit. What's the reason why banks cry today? Suppose you are a traditional savings bank or a postal bank. Your business is to collect deposits from private individuals. These depositors usually have their money on the current account and earn little or even no interest rate. But of course, operating the branch network, operating the IT network in order to allow transmission, transfer of money and all that kind of thing is a huge fixed cost for savings banks. In the past, the savings banks were able to make profits because they were able to lend the short-term money of depositors at high interest rates. Currently, if you invest your money in the short run, and savings banks should do so because after all their refinancing from deposits is short-term, so if they are cautious and sustainable, they should invest into short-term assets in the capital market. Now these assets deliver almost zero interest rate. They need 200 basis points or 2% of interest rate spread, but they can't recover this currently. So the savings bank model is really at risk if the interest rates do not change in the future. And there were two options. Either the savings banks are closed down, because nobody is willing to pay the 200 basis points interest rate spread that these banks need. Option two is the customer pays. Then you still will receive no interest on your current account, but you have to pay maybe 100 euro, maybe 200 euro per year as a fixed commission basis, because otherwise your bank cannot make the money. Or what many banks unfortunately are doing so currently is they invest into higher yielding assets. That means they take on more risk, either more credit risk or more longer maturity assets. And these increase in maturity transformation, of course, creates lots of risk if interest rates would raise in the future. And therefore, the savings bank model is clearly endangered in today's environment.
Yeah, if I pick up where Mark left, I agree the central banks have done a tremendously good job over the last few years doing whatever was needed and doing all these unconventional measures to avert a much bigger crisis. But I think while they have been ahead of the curve for the last 3-4 years, it's going to be incredibly difficult for them to stay ahead of the curve for the next 10 years because developed society has a problem with prolonged negative real interest rates. And there are tensions building up, and most of these tensions have been never experienced before. So while we had periods of low interest rates in Japan and Switzerland for a prolonged period of time, we didn't necessarily have periods of prolonged negative real interest rates for a prolonged period of time. And while 10 years ago, the central banker had to estimate the output gap and adjust the interest rate accordingly. How to get out of quantitative easing is a much more difficult task, and I'm not envying Ms. Yellen and Mr. Draghi for their task ahead. So I think that a society it's economic, but it's at one point also a social phenomenon. Will need positive real interest rates again to survive in the form we're used to invest, to live, and to age.
Thank you, Jens. A strong statement. And so the idea now is just to take a short view to the future, because we have evaluated the situation now as it is from the different fields of experts here. And the idea is just to think about what could the implications of such a low interest policy be more in the long run. And from this point of view, it's interesting also that a study was published recently by a German professor of business management, Mr. Nolte, who was warning about the dangers, especially for savings banks, because he said that their business model is not sustainable enough for, in the long run, to hold and to live with this low interest policy. I'm just thinking it's interesting to see certain aspects of low interest policy. It has effects to traditional banks, it has effects also to economy as a whole, and it has effects also to individuals. And I would ask my expert panel here that we come into a more lively discussion to these certain aspects. So what is your opinion, Marisa? What do you think, what will be the effects of the low interest policy for the individual more in the long run?
Well, I'll be a bit provocative, and I have been fascinated by the study of demographics. And some of the statistics that I've come across recently, and as I'm delving into the subject matter a little bit, is that in our lifetime, the scientists are telling us that they are likely to find, this is my lifetime, not your lifetime, so in my lifetime, a cure for both cancer and heart disease, which are the two biggest killers of the Western world. And they're also saying that the human body can technically live to the ripe old age of about 135. So if you think that you take away two of these biggest killers, and all of a sudden we can live to 135 years old, we're also seeing every generation that comes behind us lives another 10 years. That's an absolute fact. So your children will live 10 years beyond you, and they'll live 10 years beyond that. Most of us have a number in our mind that we've saved for. Certainly at our age, we're probably in the twilights of our career, if I can be so bold. And probably in everyone's mind, you've saved for that magic number of your retirement or how long you're going to live. And if you have the two phenomenons of the demographic equation, meaning that you're going to live another 10, 20, or 30 years beyond your hurdle rate, and in addition to that, all the money that you've got in savings is actually declining on a real basis, we have a real problem in our society. So that is one implication that's a real issue. And we are going to have to get a return on savings and investments in order to be able to cover ourselves in retirement. And that is a big issue, particularly in Western Europe.
Comments on that?
Yeah, I would like to just add to this. Yeah? Simply suppose that you want to save your retirement, and we don't have the German pension system, but you really have to save your own money. When interest rates are roughly 7%, then your investment doubles in 10 years. If you save for 30 years on average, you start saving at 30 and you retire at 60, you have 30 years to keep your money growing. That means you have 3 decades of doubling the money. So €1 becomes €8. And you have to save €1 in order to get a pension income of €8 at the age of 60. Now suppose you have 0 real interest rates, which we currently have. That means you have to save €8 in order to have €8 at the age of 60. So the amount of saving really changes dramatically. It's not a small shift. It's a dramatic shift. And you either have to save a lot more, or you have to work a lot longer.
Work till 125 instead of 110.
But low interest rates are definitely very bad news for everybody that saves money for the long run. because the longer you have your capital invested, the bigger will be the opportunity loss. But for me, the key question is that likely to happen? Will investors simply keep on saving? And there were actually two very different theories. One is you actually save more. Interest rates go down and you think, well, savings becomes less attractive, but I need money at the age of 60. And given the low interest rates, I have to save even more. And of course, saving more keeps the interest rate low. So there are actually many economists who think that there was no problem because people always save, and if saving is less attractive, they save even more. So this is a sustainable situation. The other people say it's not sustainable because sooner or longer, monetary easing will create inflation. If people just think about inflation, if they just believe that next year the average consumer price will increase 5%, then investors will most likely demand a compensation for that. If then long-term interest rates suddenly jump up by 5%, this may really bring a disaster to the whole economy. This may lead to a lot of defaults by corporations who can no longer pay the long-term higher interest rates. That may lead to sovereign borrowers like Italy and Spain no longer able to service their debt. And there was no response by central bankers because never forget that central banks can more or less precisely control the short-term interest rate, but they have almost no control beyond rhetorics and convincing arguments to control the long-term interest rate. They have affected the long-term interest rate in the past. This monetary twist that the American Fed did by simply buying into long-term securities really brought down the long-term interest rate to record lows, but there was no guarantee that it stays so. The American Central Bank cannot continue to buy government bonds without bounds. And if investors really go on strike and say, I don't trust in long-term bonds, fixed income securities anymore, then nobody knows what happens.
Okay, so what we hear from the current panel here now at the moment is a lot of skepticism regarding low interest policy and the consequences. On the other hand, one has to see that it's of course a result of the very high debt level of certain countries and states, and it was the try of an answer the ECB has given. So my question would be to Jens, what are the consequences from his point of view, and how he would evaluate the long-term consequences from this low interest policy for capital markets? What do you think, Jens?
Well, I think at one point we run the risk of seeing what Mark said, that investors will go on strike. You're not gonna. It's fine if your asset price continues to go up, like the equity markets have or the bond markets over the last few years. That even if you get a low yield or in real terms a negative yield, as long as the asset price goes up, you're willing to sustain that. But at one point, if asset prices are not going up anymore and the yield looks kind of dubious, you stop buying the asset. And the question is, how will the different markets react to it? But I think there is a real risk over the next years that one market will see a sudden sell-off. And for me, a phenomenon like Bitcoin is also, in the end, driven by a low real interest rate environment because people just look for other assets to invest in. I mean, if you told somebody a few years ago that you would invest something where you get 0 interest rate and you're virtually at political risks of regulators and it's totally unregulated, people would have said, are you mad? And now everyone has seen the prices. So I'm not saying it's irrational, but I would strongly argue that if the real interest rate was 3%, this wouldn't have happened or couldn't have happened.
Thank you, Jens. Bitcoin is a very interesting word. So we have the situation that in Germany a pub is just accepting in Bitcoin. I've read this 3 days ago. So if you want to drink a beer, and it's in Berlin, and he's accepting Bitcoin for the beer. The question is Bitcoin. The German Bundesbank, Mr. Thiele has warned because of Bitcoin, he said it's highly speculative. So, Konrad, what is your opinion on Bitcoin?
Well, I actually don't know that much about it, but I think, and I would agree with Jans about the rise of the asset prices, and I would also like to stress. I mean, we are talking now about individuals here, but also let's think about pension funds. They are regulated, at least in Germany, to invest a certain share in certain assets which are said to be safe, or they may only invest a certain share in equities or private equity or whatever it is, and they are not earning enough on that regulation. So they are, I think, going to put pressure on the regulators to increase their risk in their portfolios, to somehow create a better return for their clients, because we are all investing and putting our money on at the trust of someone else to gain a certain interest rate, and we are promised that our €5 will be whatever, €80 in 60 years. And we don't see that at the moment on our regular yearly slips, which we get. And I think rationally there are a lot of reasons in this panel, but again, I think perception is and behavior is something which we should also include in our equation. And I'm not seeing that in a macro political way, but I would be very interested to see your viewpoint on irrational behavior also in corporates or at pension funds in banks. How do they react looking forward on that interest rate?
I mean, I could maybe jump in on one thing on expectation as to whether we will be forever in this low interest rate environment. I mean, I see it every day because I'm financing companies, I'm in the market with investors, and investors are very quick to react when their psyche changes. And there is a product in leveraged finance called a floating rate note. And what that basically means is the coupon is tagged to a margin over Euribor or whatever the benchmark treasury is. So if you do have rate increases, your overall cost of capital will rise with that in concert with a change in the interest rate. 6 months ago, as people felt that the low interest rate environment was going to continue, and we had so much capital chasing yield and taking overall yields down, you couldn't sell a floating rate product. I mean, everything was a fixed coupon. All of our investors wanted it, and that's what the issues were getting. Fast forward now, 6 months later, and I can't sell enough floating rate note product. All the investors want exposure to floating rates because their view is interest rates are going up and they don't want to be caught investing in an 8% coupon bond when, in fact, you know, if rates rise, that really ought to be a 9% coupon bond. So from my standpoint, the market is already anticipating those rate increases and demanding that as an investment proposition.
Marisa and Konrad, you are just of course have a lot to do with companies, and the situation now is of course that cheap money is perhaps the best possible means of perhaps making an acquisition. What do you think? Is this cheap money driving acquisitions strongly, and does it perhaps lead to some exaggerations that, so for example, some acquisitions are done which haven't been done or wouldn't been done when the interest would be sometimes higher?
I mean, I can tell you, since I see both the corporate world and the financial sponsor community, the answer is very different depending on which world you're talking about. So typically, and this is with all great respect, private equity is largely known for financial engineering. So the power of leverage is what drives their returns, not always really a corporate thesis in terms of combining two companies for synergy plays or what have you. In the corporate world, it's very different. Most acquisitions are driven by whatever the synergies are that you can create out of that combination. So therefore, what is fundamental when you are doing a corporate-to-corporate acquisition is the mindset of the chief executive of the board of the acquirer. Do you have confidence in the price you're paying? Do you feel good about the valuation that is on the table? And do you feel confident about where the world's going? And if the answer to those three things is yes, then you tend to see very high levels of acquisition activity corporate to corporate. And the reality is, right now, we're still in a fragile state. It's getting better, but we're in a fragile state in terms of the psyche of boards and chief executives in Europe. When I go around and I meet with my clients, they say, boy, would we love to buy division X or company Y, but we're just not sure yet. We're just not there yet, and our board is not supportive yet, so we're not seeing a lot of acquisition activity. And in fact, last year was the lowest. Every year I've been saying it's the lowest ever in 5 years, and then it becomes the lowest ever in 6 years. Once again, M&A volumes in Europe were down another 33% if you strip out one very large transaction that got done. The flip is true for private equity community, and you can certainly speak to it as much as I can, but from a financing standpoint, what I see is with this incredibly low rate interest environment, the access to this cheap capital is absolutely fueling private equity demand. So deals that couldn't otherwise get done, or purchase prices that you couldn't have otherwise paid, because I can give you a large amount of leverage and I can give you it at a very cheap cost, it's going to allow you to pay more, and that is spurring a lot of deal activity. It's also allowing you, I think, to, in the private equity community, to raise a lot more funds because your investors seeing a lot more of that deal activity. So very different phenomenon depending on which type of client base we're talking about from my standpoint.
Yeah, absolutely. I mean, lower interest rates, and what we see when you take 10-year bonds over the last 15 years, they have been decreasing, and it's a very significant negative correlation to deal activity and private equity activity. So private equity activity went up considerably over the last 10-15 years. What we see now is a reaction to that phenomenon, that the leverage effect as such is not the only wealth driver in the private equity community anymore. So people are starting up and building up operating partners. They are at least putting it on their website that they are really going into the companies and really looking for operating change, not only financial engineering. And this is also changing the face of private equity. It's not only number crunching anymore. It's more and more really getting a decent story in front of your investors to convey them to invest in your fund going forward.
I agree to what you say, but I'm really frustrated. And the reason is the interest rates are so low in order to end the credit crunch that we observe in Southern Europe. Southern Europe really has a structural unemployment problem because corporations stop investing and banks stop lending money. And cheap money should actually make corporate investments more attractive. Now we are talking about leveraged finance again. Cheap interest rates are, of course, increased leveraged finance, but leveraged finance was exactly that kind of financial innovation that was one of the reasons for the crisis in 2007.
Excesses in leveraged finance. Leveraged finance otherwise is a very good thing.
I think with cheap money, we repeat exactly the same faults that led us to the crisis, and it's just a mess that the European Central Bank cannot, of course, control the money flows, and the money does not flow into investment, into generating new machines and production, especially in those areas where it's urgently needed. But it's really flowing where panicking investors or leverage-driven investors see the best opportunities, and that seems to be leveraged finance, LBO kinds of transactions, that seems to be equities currently, that it's still some precious metals, and I hope that sooner or later people will return to the fundamentals and think that sustainable growth is really done by corporate investments, and that private equity managers predominantly think about growth financing of great corporations.
Thank you, Mark. Just one question to Jans. Deutsche Bundesbank has warned because Bundesbank sees the danger of a bubble, especially for corporate bonds and government securities. The only asset class Bundesbank is seeing not so many exaggeration is the stock market. So what is your impression, what is your idea, when will we see the next bubble in the European or worldwide stock markets?
Well, for me, it's first most interesting that the Bundesbank starts talking about asset prices, because I still think that a central bank should be concerned mainly with inflation. But you see it in the United States, where there's a big discussion about should the central bank not. In the United States, we already have the dual mandate of employment and inflation. Now there's discussion, should they also include asset prices, because asset prices are a measurement of perceived wealth, which indeed will feed back into consumption. And you've seen now the Fed saying, oh, we might taper, and you have 10 prime ministers of emerging markets screaming you can't do that. So the poor central bank, out of a sudden, I mean, they're playing Sudoku. They have to square the thing, and the numbers don't match up. So I think it's very interesting when you see now the Bundesbank, which is the most traditional actually of the central banks, I would say, with regard to the inflation target, now also starts to talk about asset prices. And I don't think it should not be the task of a central bank to influence asset prices, and that the markets have to function themselves. They have to make sure that the infrastructure is intact, and where we discussed if bank stops lending, they have to step in, but to control asset prices is a very difficult matter, because in the end there we end up with society again. It's our decisions, what we want to own, what we want to invest in, and what not. So I'm not there to make a statement about where the equity markets are going. I wish I would knew where it's going, but I think this politicization of central banks is getting very interesting. Yet on the other hand, the Bundesbank in the 80s, they always said, well, everyone is affected by inflation, so everyone should be concerned about inflation. They said, you know, the people of a state shouldn't only look at the central bank, right? It's all our common goods and money, and the same is true with if you just flip the coin, you can say the same with low real interest rates. Everyone is affected by it, so everyone should care about it.
But you can't divorce monetary policy also from regulatory policy. And one of the things that we certainly see in our world is with the very great desire of politicians and regulators to avoid another crisis, they have put in place all of these capital rules on banks. Basel III is the phenomenon that we live in, one of the worlds we live in, one of the metrics we operate by. And the way Basel III works is, if you are a bank and you lend to a non-investment grade company, or by definition oftentimes a small medium enterprise or an early stage company, to lend that capital under Basel III is punitive. It's extremely expensive. So the byproduct of that, of course, is the banks are not lending to those companies, which is the very thing that the politicians want the banks to do, because that's in theory what's going to jumpstart the economy. So you have this funny circ function of, I want to protect the world, so I'm going to put these regulations in place, but those very regulations are stalling the economy. So what's happening is the capital markets, the institutional investor world, is stepping in to fill that gap. And so we can debate whether leveraged finance is good or it's bad, but I certainly have a biased view because I've been in leveraged finance all my life, and I've seen leveraged finance build almost every major infrastructure industry. If you look at the US, oil and gas, telecom, cable, all of that is founded on leveraged finance, because those companies were voracious users of capital, and there wasn't enough bank capital available. And in Europe, as we're shifting away from a bank model to an institutional investor model, without that ability to finance those companies through the institutional investor market, I think we won't see economies recover. So it's an interesting debate as to good and bad on the credit spectrum.
Thank you very much, Marisa. So now we should start with a discussion here with the audience. I think it's your time now to ask your questions to these four excellent experts here. So who would like to start? The ice-breaking question, please. This nice lady with the blonde hair. So please, ask your question.
Always the ladies in the room. Robin Pope, Graz University. Thank you very much. I would like to ask two questions. One is of Jan's in suggesting let the private markets do it when it comes to assets, but not to goods and services prices. That seems to me very peculiarly skewed, that asset bubbles have been in the recent past and all through history, the housing bubbles, one of the biggest costs to countries, not individual goods prices. So it would seem to me that this is where there should be more public interest instead of the other way round. I'm not suggesting that the central banks alone should do it. And then my question to Marisa is, I entirely agree that the Basel Accords have missed the mark on what you do for stability. However, the claim you make that the grand investment banks were needed because nobody else could do it seems to me a little unsubstantiated. It would seem to me that, for instance, in lending for the big infrastructure projects you mentioned, these got underway before we had any of the punitive Basel ones. I would suggest to you that it can relate rather to deregulation, and that one cannot say that all this deregulation was good the way you are suggesting it is.
Okay, if I kick off with the first one. So, regarding the housing bubble and the cost to society, I mean, we cannot argue about that, because I think to a large degree also the financial crisis of 2008 was born by the idea that everyone should be able to own a house even if they don't have enough money and income, and that led to an over leverage. However, I think you have to be careful between what the central bank should be doing and what the government should be doing, because I have not been voting for Mr. Draghi, or neither any American voter has ever voted for Ms. Yellen. So you can vote for the executive and the president and the chancellor, and that's fine, but you cannot vote for the central bank. So the central bank, if you want to control the housing market, for me that's something the government has to do. And in the UK, you've seen some headbanging between Mr. Cameron and Mr. Carney about the housing policies, and obviously one is influencing the other. But if you want to avert a housing crisis, I think it's more in the purview of the government than in the central bank.
Marisa.
So turning to your questions and comments, I guess, first of all, just to be clear, what I wasn't saying that all regulation is bad. What I'm saying is there's a perverse outcome with the regulation that's in place now trying to avoid the next crisis, because it's actually the way the regulation is manifesting itself, it is causing banks to step away from lending to a lot of the companies that drive economies. And to your point on infrastructure projects, interestingly enough, almost every major investment bank is out of infrastructure lending now. You have a handful of banks that do it, but all these infrastructure projects are massively over-equitized. Pre-crisis, pre-regulation, there was a lot of debt that funded these infra projects. Now it's almost all equity. So the regulation is actually taken it out of the debt hands, so it's become very much more costly, because equity obviously is more expensive than debt. And in some cases, to get those projects off the ground, the governments have had to provide guarantees when in the past they could have done it on a private basis. So again, it's part and parcel to this regulation of saying they don't want banks to be lending to risky projects with uncertain outcomes. So I'm not saying that regulation is a bad thing. I'm just saying it does create some interesting outcomes that we're all living with now and grappling with. And by the way, another bubble that we see getting created, certainly in the UK environment, is with the UK banks not lending to the small and medium enterprises. There's a whole shadow banking system that's taking place now, with funds getting raised, away from banks, but funds getting raised to lend to these SME companies, but they're doing it at effectively usurious rates because they can, and they're the lender of last resorts. And some of these loans are double-digit interest rates when you actually have base rates at close to zero, and these poor companies have no other choice. And because the banks aren't there by virtue of this regulation, and that's a whole other area that I think will be another bubble, and I think the regulators are just picking up on it now. So
a very interesting statement by Marisa. I think you were just appealing to the situation that banks are regulated quite heavily, and on the other side, some so-called shadow banks like hedge funds are not regulated at all. Huh?
correct.
Okay, that's the situation. So guys, who's next with a question?
Thank you very much for a great discussion. My name is Colin Zhang from the University of Chicago, and I have a question about the future. Do you think the world of cheaper money will be changing in the next 5 years? If we look at the three major economies in the United States, the QE policy is coming to an end, and in China, the central government tried to increase more internal control in order to fight with the inflation. And the Abe in Japan, Abe's economy also facing some domestic challenges. So do you think the trend of cheap money will continue or will come to an end eventually? Thank you.
So to whom did you address the question?
My name is Colin Zhang from the University of...
To everyone.
To all.
So I will hand this to Mark.
Yeah, I think your question is really the most important question. If we were living in a closed economy, I would be very optimistic that the central banks have enough authority and power to do whatever is needed. And Japan is perhaps one example where even the strong collapse of real estate and stock prices in the 80s did not lead to things like hyperinflation or government default. And of course that's because the Japanese economy is able to sustain the highest sovereign debt level simply because it controls a lot of the savings channels towards these debts. But in Europe and in the United States, we really live in a much more open economy. And when China should decide to open its capital flows also, then asset prices in Europe will be mainly dependent on where Chinese investors put their money in. Now, imagine a scenario where China loses its confidence in the dollar and shifts its money into euro instead. That would be a catastrophe for the dollar and vice versa for the euro. But it could be exactly the other way around. Now, its European Central Bank cannot control the confidence of Chinese investors towards the euro. Currently, I think we live in a situation where all the big central banks basically do the same policy. The Fed in Washington, the ECB in Frankfurt, and the Bank of Japan in Tokyo, they all do the same monetary easing policy, and that actually leaves investors no choice. They have to live with low interest rates, they have to live with negative real interest rates. But suppose one of these three banks would change their policy and would offer a real solid positive real interest rate investment, and all the Chinese money, for example, would flow to this country. That was a real danger to the others. And therefore, the question to your answer depends a lot on the extent of international cooperation. Because nobody can live on cost of others. And if the Basel Committee, if the G20 or G8 continue to be successful in really coordinating international policy, then we might be able to prevent this massive shift of investment flows from one area to another, which would then create and create bubbles and let other bubbles burst. I'm actually cautiously optimistic concerning this, because politicians reacted in a very cautious and coordinated way towards the crisis. But we don't know how a player like China, for example, will play this game in 5 years from now.
Konrad?
Maybe back again to some more individual level. I think there is a saying, perception is reality, and I think everyone is percepting that interest rates are going to rise. And I think we should be sensible in preparing that this might happen. It's the same with your clients. You're advising get cash in for lower interest rates. It's the same in our industry. We are preparing as a whole to increase value also through other means than leverage, because we think we will not be able to participate solely on that leverage effect going forward. I said that asset prices or valuations at the moment are probably at their pretty high. Maybe they're going to rise a little bit more, but from us, when we are looking at an investment opportunity, we actually would never think that we will. It's also not considered being conservative to keep the same multiples in an exit scenario. We are actually planning with lower multiples, so we have to create value by other means than by using the low interest rates which we have at the moment, and it's probably risky to assume that it's going to stay for the next 10-15 years or whatever it is, even though it might happen.
And if you have read the esteemed paper of our former colleague here, today's, I don't know if anyone's seen it, but they basically say that in the UK, the expectation when you poll, and if you look at the curve, it's all saying that the likelihood of a rate increase is now being brought forward by at least a year or two. So I think, you know, even the markets really are saying that they see it happening. It's just a matter of sort of when.
Thank you. I saw a hand there, over there.
Raise it, please, again.
Huh?
Where?
But now it's gone.
It's gone.
So, next question, please. There's the other hand. Okay, thank you.
Vielen Dank. I'm with Deutsche Bank. I would have one question. Who, in your perspective, did a better job dealing with the crisis, the US or the European institutions? Thank you very much.
So we didn't get it perfectly. Could you again repeat it?
My question was, which institutions did better with the financial crisis? Those in the US or those in the European Union? Thank you.
Mark?
Well, I personally think the US did better, but they had the easier job at hand because they really have a very integrated economy, whereas the ECB is faced with so many problems. And as Marisa has put it out, right, so there are a lot of people sitting an hour's drive from here in Frankfurt scratching their head and saying, okay, we gave the German economy everything they need, cheap money, and the economy is growing, yet why are they not investing more? And some of these traditional mechanisms on which central banking relies in their toolbox have been just much more ineffective in Europe than in the US. So the US had an easier job, I think, because it is still a problem in the Eurozone that we don't have the same labor mobility, and there is just a humongously huge difference between Helsinki and Lisbon and all what lies in between. And so I think the guys in Frankfurt have done slightly worse, but you can't really blame them because they had even a harder task at hand.
Yeah, I would completely agree. If you look at all the banking statistics concerning profitability, non-performing loan ratio, and so forth, the US banks show much stronger results since at least the last 12 or 24 months, especially when it comes to loan loss provisioning and non-performing loans. And that is probably due to the fact that that the American mortgage market found its bottom. House prices are no longer declining, whereas in Europe they still are sliding downwards in some countries. But the overall macroeconomic situation in many parts of Europe is simply a disaster compared to America. And probably one of the European disasters is also that banking is so much more important for Europe than the commercial banks in the United States. Commercial banks is a small part of the American economy, and most of the lending is really channeled through capital markets, be it debt, be it equity. But here in Europe, as long as the banks are suffering from a big and severe disease, we cannot expect that the European economy will quickly recover.
And I have to agree, because, but as seeing it with a slightly different point of view, running an investment banking business, one of the biggest issues that I face every day is wondering which regulator in which European jurisdiction is going to put in place a new rule that I'm going to have to migrate my Titanic ship to try to address. And at least in the US, so that's why I keep coming back to, you can't divorce the monetary policy from the regulatory policy, because that's the other thing that is really kind of crushing us in Europe. One day I've got the PRA telling me what to do, the next day I have FINMA in Switzerland, I've got the EU that wraps its, and a lot of this is very politicized, and because you have obviously so many countries with so many vested interests, all wanting to put their stamp on things, that's also causing great disruption in Europe, and it's much, much cleaner in the US. One regulator, one policy, and by the way, they force the banks to take the capital. Not to say I'm guaranteeing it. We had this discussion on the way over here with my colleague that that made it simple. You didn't have a choice. You took that and it sort of flushed the system, whereas here it just is prolonged, backstop in the form of a guarantee, and that just makes no action happen because you sit there and say, let me just write it out, write it out, write it out. And I think all of these things would obviously lead us to the conclusion that the US has been much more proactive, but it's also at an easier time.
Okay, I think we have room for one question left. So the last question. This young man there.
Hello. My question is probably most suited for Ms. Drew, because it's corporate focused. I'm wondering, I've read a couple of statistics that emerging markets corporates have increased issuing in foreign currency, so in particular in US dollar, due to the low interest, essentially what Mr. Meyer said, get cash in as long as it's there. Yes. And on the asset side, on the other side, they mainly, at least partly have domestic currency or non-US dollar assets, so there's a currency mismatch. So do you think there's room for a bubble or that could burst, and given that emerging markets have increased their significance in the globalized industry, that could essentially affect everyone, not only emerging markets, but essentially also us?
Yeah, anytime you have a currency mismatch, clearly that's a risk. I think the companies who do have access and ability to hedge are being smart about their hedging policy, but in some of these emerging markets, you simply can't get a cost-effective hedge and they're going naked, and that is a risk, clearly. But then you offset that risk if you step back at the corporate level and say to yourself, access to capital at the cheap price, or effectively no access to, say, debt capital in my home market, or very limited, and I've got to over-equitize. You have to look at the total cost of your capital structure and that that money that you need, and sort of run those risk scenarios. But yes, I agree with you. If you have a big movement in a currency and somebody's gone to the U.S. because it looks cheap, that therein can lie a problem. On the other hand, what's very interesting is in more liquid currency markets, we're doing a lot of financings now, especially very large financings for large corporates on the acquisition finance side, where they need so much capital, they've got to go to multiple jurisdictions in order to be able to tap all markets effectively. And in some cases, what we're seeing is, we can get very good swapped rates on 10-year money, and it ends up being cheaper to issue in dollars and say swap it back to sterling or swap it back to euros. All in, the cost is cheaper over a 10-year period as long as you're not going to break that hedge. So it almost is a little bit of, depends on which market you're talking about, but true emerging markets, it's always a risk.
Okay, thank you, Marisa. Thank you to the audience. I think at the end, I would like my colleagues here to sum up their impressions of the discussion today and their personal opinion on the consequences of low interest policy in 10 sentences. Just very brief, just what you take out of this discussion. Jans, would you like to start?
Well, I take out of this discussion where I started, that it's difficult. It's really difficult to get out of it, and there's a lot of different opinions, and there's a lot of diverging effects, and you bump the system at one end, and it has ripple effects into a lot of other things, and it's very hard to get out of it in a coordinated manner by just anticipating what's going to happen. So I think we all need a bit of luck to get out of it.
Yeah, my takeaway from this is that it's not the low interest rate that is really dangerous, but the uncertainty. Yeah? If people know that rates will stay low in the end, yeah? Of course it would be bad news for savers, but they would adjust. Yeah? And investors know what to expect. Yeah? But if nobody knows how the long-term interest rates will change in the next couple of months or years, yeah, nobody knows how the regulators would respond to that, then this creates a lot of uncertainty. And the message to me is uncertainty creates opportunities, yeah, but also creates massive disasters, yeah, when people invest in the wrong market, like bitcoins or like any other asset price bubble, yeah, and that could of course have disastrous effects, and that's why my takeaway is also that the predominant role of regulators is unlikely to fade away soon in the near-term future, because regulators step into the market when nobody trusts market prices anymore. And of course, I agree with Jans that we would like to have investors create market prices and regulators create only the regulatory landscape. But that's unfortunately not going to happen in the near-term future.
Thank you. Marisa.
I guess I would say when the history books are written and we look back maybe 10 or 15 years from now, what we'll see is that there were very little tools that you could work with, particularly in Europe, given all the dynamic we just talked about and the competing interests and what have you. So monetary policy had to be a piece of that. And I think that it was the catalyst to create liquidity in markets. There are all sorts of byproducts to that, but I think it will have served its purpose when the history books are written. And I also am a firm believer that we will see rate rises, in which case this ultimately, in my personal opinion, will somewhat self-correct.
Konrad.
I think the uncertainty is an interesting aspect, and I think in combination with the desperate need to realize yields higher than we can get on the market at the moment, people get creative. And that's also why I think the regulation is going to stay in place, but it's going to be even more challenging going forward, because you said debt funds are being raised. We see that. We saw a leverage buyout financed by Allianz. So we see a number of new institutions coming on the market, trying to better their interest on their capital, and they do it by ways which are not regulated at the moment, and the regulator will continue to run behind the innovators up front, and it's going to be interesting. It's going to stay there as long as the low interest rates are there. When they rise, I think we will see reduced innovations in institutions. Because the established players will pick up that market back again.
Thank you very much, Konrad. I just would like to say thank you also to this audience, to the very interesting and focusing questions. And I wish you have a very nice second day of this Campus on Finance. Thank you.